Lecture 4, Mutual Funds and Other Investment Companies. In this lecture, we will learn the types and services of investment companies, differentiate between open-end and closed-end funds, understanding the fee structures of mutual funds, including the calculations of net asset value, offering price, and then we will make choices of mutual funds based on their fee structures and introduce ETFs and hedge funds. Investment companies refer to pooled funds from individual investors and invest in a wide range of securities or asset classes. Investment companies provided services include such as administration, bookkeeping, and they help to diversify your portfolio, and you can purchase the units or the shares in fractional shares, and provide professional management and reduce just transaction cost. So by purchasing one unit of one share of the funds, you will be able to obtain exposure to hundreds, if not thousands, of securities. The major investment company types include, number one, units. Unit investment trust, they refer to passive index portfolio. They are unmanaged. Number two, managed investment companies that include three types: open-end funds, typically called mutual funds, ETFs, which are offshoot of mutual funds, and closed-end funds. And the third includes many other types, such as commingled funds and the partnership for investors that pull their funds from a certain company or a certain group. And REITs refers to real estate investment trust that's similar to closed-end funds but focus on the investments of real estate properties or loans secured by real estate properties. And hedge funds, which are open only to accredited or institutional investors. Looking at the shares of different types of mutual investment companies, it is clear that mutual funds are the dominant types of investment company. And ETFs has been growing tremendously in recent years, with others relatively small. It's important to distinguish between open-end and closed-end funds. Open-end funds are commonly called mutual funds. So you can only purchase or redeem your shares with the management at 4 p.m. of the trading day. They are not traded on stock exchanges. All the orders submitted prior to 4 p.m. of the trading day will be executed at 4 p.m. of the next trading day. Okay, and open-end funds are different. Okay, closed-end funds are different. Closed-end funds are not traded with management. Instead, the trading occurs between investors on stock exchanges. Okay, and therefore closed-end funds don't issue new shares. And once the primary offering has occurred, the management would take the investment pool and invest with the given pool of money. And new shares will be issued unless new offerings is done. In contrast, because open-end fund allows investors to purchase new shares or redeem their existing shares, the shares outstanding changes daily based on the net inflow or outflow from the funds. Because closed-end funds are traded on the stock exchanges like a stock, so the price may deviate from the net asset value. So this closed-end fund may trade at a premium or discount, and on average, they tend to trade at a discount. But in contrast, open-end funds are priced based on the net asset value, which I'm going to introduce in a second. And plus, so when you purchase or redeem the open-end funds, you may pay additional fees associated with the funds. Net asset value is a measure of underlying value of an open-end fund or closed-end fund. Okay, it refers to the value of the share in the fund, and the calculation follows this equation. You take the total market value of the assets in the fund minus the total liabilities that has accrued and divided by shares outstanding. So this is the net asset divided by shares outstanding, and it's called NAV. For instance, a mutual fund with 5 million shares, 100 million, 20 million shares worth of security, and liability includes advisory fee $4 million and other liabilities of $1 million. What is the net asset value? To calculate net asset value, we take the total asset 120 minus the total liability 4 plus 1, that's 5. So we have $111 million divided by 5 million shares, and the calculation gave us $23 per share net asset value, NAV. Okay, so I gave you the exercise in the classroom. In the exercise, the net asset value of the fund is 200 minus 3. Liability divided by 5 million share is $39.40 per share. Because this is a closed-end fund, it sells on the stock exchange for $36 per share, which is below the net asset value of $39.40, which means the fund is selling at a discount, and the discount is $3.40, $3.40. With a percentage of the net asset value of 30/40, it's 8.6% discount. So the negative number here refers to the discount, and 8.6 refers to the size of the discount. Open-end funds have dominated the U.S. With 90% of assets managed by mutual funds, and in 2017, it's over $16 trillion, and nowadays it's even bigger. But recent years' growth in mutual fund has been small. Okay. So mutual funds have to state their investment policies, basically the type of asset classes they concentrate and the investment objective of the funds. Okay, and several common investment policies include the following. Money market funds refers to investments in short-term treasuries or money market instruments. Fixed income funds invest in debt instruments that could include corporate or government bonds. Equity funds invest in owning common equity or stocks. Index funds follow a passive strategy and track a broad market index that could be stock, bond, or some other indices. Asset allocation funds that's being actively managed to engage in market timing by shifting assets from stocks to bonds and back and forth through their forecasting model or through the demand of the investor. So one of the common asset allocation funds refers to the target retirement date fund. Okay, you can, when you invest, you can select the funds within a year referring to your targeted retirement year, and the funds is going to shift between stock and bond over time based on your estimated horizon to retirement. Special sector funds includes industry funds as well as international stocks or bonds. Let's discuss the cost of investing in mutual funds. Okay, the most important cost that occurs annually is operating expenses. Operating expenses covers administration expenses as well as advisory fee that can range from several basis points to up to 200 basis points of the total assets. It's periodically deducted from the fund assets, so the net asset value has reflected the deduction of operating expenses. In 1997, the average expense ratio is about 1%. In 2018, the expense ratio has been nearly halved, referring to which suggests the declining expenditure. I encourage you to read the attached link here for more information about operating expenses. The second type of fee is called front-end load or sales charge, which is represented as the percentage of the public offering price, POP. We will discuss about this in the next slide. It refers to the sales commission paid at the time of the purchase. Nowadays, most of the funds are called no-load funds, referring to no charge on the front-end load, okay? And back-end load refers to redemption fee, and it occurs at the time of the redemption. In most cases, it starts with a positive number and it gradually lowers every year or every month and becomes zero in the long term. 12B1 charges refers to the annual fee paying for marketing and distribution of annual reports and prospectus. It's based on the regulation. It's limited to 1% or less than 1% of fund average asset per year. It's annually deducted from the fund assets. Okay, I encourage you to take the link, to click on the link and go through the prospectus of T. Rowe Price New Horizon Fund that details many of the charges. So let me go back to front-end load. Front-end load is quoted as a percentage of the POP, the full price or the offering price, okay? So in other words, when you see the full price is the sum of net asset value plus the load. And the load is the percentage load times POP. So if we move the NOV to the left-hand side, NOV is equal to the full price POP times 1 minus the percentage load. Therefore, POP is net asset value over 1 minus the percentage load. For instance, if an open-end fund has net value of $10, its front-end load is 6%, what is the offering price? So the offering price, we're going to use this formula, taking net asset value 10 divided by 1 minus the front-end load percentage, we get $10.64 per share. Therefore, when we pay $10.64, $10 is invested with the funds and 64 cents are paid to the management as the front-end load. And the exercise here asks you to calculate net asset value, which is going to be the total price, $12 times 1 minus the percentage load, which turned out to be $11.40. So how is return on mutual fund calculated? This is reported quarterly or monthly on the mutual funds website, okay, or in your monthly or quarterly reports. The rate of return on mutual funds is based on the change of net asset value, accounting for distribution and income. So we take the net asset value at the end of the period minus net asset value at the beginning of the period, plus the income and distribution during the period, okay? The distribution comes from capital gains and income can come from dividends. And mutual funds are required to distribute 90% of their capital gains and income to the shareholder at the year end. So that tells the net income, net profit from investors divided by the initial net asset value. That's the reported rate of return during the period by the mutual fund. For instance, the initial net asset value 20, income distribution 50 cents, and capital gains distribution 5 cents, and ending net asset value 2010. So what's the rate of return? Net asset value has changed by 10 cents. Distribution is 20 cents. So the net income, net change is 30 cents out of 20 of the initial net asset value, and the rate of return is 1.2%. To understand how mutual fund fees can have a big impact on the long-term performance, we want to explain this through the calculation, an example, okay? And here, if Just to clarify, so when we consider the net return to the investor, we have to consider front-end load, back-end load, 12b-1 charges, and 12b-1 charges occurs every year, so it's going to impact the net return of the mutual funds. So you take the return on NAV and minus 12b-1 charges, that will be the net return if there is a 12b-1 charge. Okay. So we're going to look at this example, which shows different investment horizon can lead to different choices of mutual fund classes. A typical mutual fund would offer multiple class shares to investors based on their needs, that differ in fee structure. In other words, those asset class shares refers to the same underlying investment pool, but they differ in how much and how they are going to charge investors. In this example, Class A charges a front-end load of 6%. Class B charges 12b-1, 50 basis points per year, as well as the back-end load that starts at 5%. The back-end load will fall by 1% for each full year the investor holds the portfolio. So in other words, after the 5th full years, and the front back-end load will go to 0. We assume the portfolio rate of return net of operating expenses is 10% per year, and that applies to both Class A and Class B shares. So the question is, if you're investing $100,000 and plan to sell the funds after 4 years, and which one of the two class shares is a better choice? We'll first look at investment in Class A. On Class A, you have to pay 6%. In other words, only 94% of the share value is invested. 94% of the investment is invested with the shares that's going to compound at 10% for 4 years. So our calculation is $100,000 times 1 minus the 6% load and 94% invested is going to be compounded by 10% for 4 years. That gives $137,625. In contrast, if you invest in Class B, you don't pay anything at the beginning. However, your annual rate of return will go down to 9.5% because you start with 10%, but you pay 0.5% per year for 12b-1. At the end of the 4th year, you're going to still pay redemption fee, but the redemption fee will be 5 minus 4, 1%. So after 4 years, the redemption fee has decreased by 4%, so you're going to pay 1%. So let's look at the calculation. Investing Class B, we're going to start with $100,000. It's going to compound at 9.5% for 4 years. At the end, you're going to pay 1% as redemption fee. So you are able to keep 99% of the ending balance. That leads to $140,328. So in 4-year horizon, Class B shares are the better choice relative to Class A. Let's look at the second example with the same parameters, except that now we're looking at an investment horizon of 15 years. What's going to change here is the calculation will compound at 15 years, not 4 years. And for Class B, there will not be redemption fee at the end of the 15 years because redemption fee has decreased from 5 to 0 at 15 years. Actually, at 6 years, it's already 0, right? So let's look at the calculation. So for Class A, we start with $100,000. It's gonna be charged 6% front-end load. It's gonna compound at 10% for 15 years. Our expected ending balance is $392,661. But for Class B, we start with $100,000. It's going to compound at 9.5% per year for 15 years. In the end, there is no redemption fee, so we expect to have $390,132. So with 15 years horizon, I'm sorry, there should be 15-year horizon Class A shares on the better choice. Okay, in real world, this is something we see that one of the funds I was considering purchase is BlackRock Advantage Global Funds that offers through my retirement accounts. And I was able to choose between A and B and C institutional shares, which is I or R shares. As you can see that the top panel here refers to maximum sales charge, which is the front end load, and maximum deferred sales charge, which is the back end load. So the front end load is in the first row, back end load in the second row. And here, this panel referring to the numbers below. So management fee is the top panel. Distribution or service fee, 12B1 is the second line. Other expenses, third line. Total operating expenses is the fourth line. And the fee waiver and reimbursement refers to the discount in the expenditure, which is second to the last line. And finally, the last row refers to the operating expenses after waiver and reimbursement. So what we want to focus on is the top line, front end load, second line, back end load, as well as the bottom line, which refers to the net expense ratio after all the reimbursement. So which one will be a better choice? Okay, and the rule of thumb here is we want to choose those without front load or back end load if possible. We want to choose those with the smallest expense ratio if possible, right? So therefore, if we use those criteria, we find out the institutional shares are the most ideal because it has no front end load, it has no back end load, and it has the lowest expense ratio per year. Therefore, institutional shares are always preferred than other class shares. But when you don't have the option to choose institutional shares, then you may have to compare with Class A, Class C, and Class R, depending on your expected investment horizon. So let's introduce exchange-traded funds. Exchange-traded funds are offshoot of mutual funds. They are a variant of mutual fund that allows investors to trade them continuously on the stock exchange like closed-end funds. Okay, a commonly known, commonly see ETFs include such as Spiders, SPY, that tracks SP 500, issued by State Street, SPDR. Diamonds, DIA, ticker symbol DIA, that tracks Dow Jones Industrial Average, again issued by State Street. Or Cubes, QQQ, that's tracking NASDAQ index and issued by Investigo. Or VOO, that's also tracks SP 500, issued by Vanguard. Okay, the good thing about ETFs is they can be traded continuously like stocks, so they have fair liquidity, and they can be sold short or purchased on margin. They have lower cost relative to trading individual stocks, and also they're tax efficient because they're not required to distribute their income to trigger capital gains tax. The potential disadvantage is because they're traded on the stock exchanges, prices can deviate from that asset value, creating mispricing. And also, you have to purchase ETFs through a broker that could incur commissions. Nowadays, most commissions are zero, and you cannot purchase them directly from the management. I encourage you to read the Investopedia article about the introduction of ETFs. As you can see that the worldwide ETF assets under management has been growing tremendously since early 2000. The first ETF, the Spider, was created in 1996, but not until the early 2000s, many ETFs started to be created. Okay, and nowadays over 3.5 trillion, over $4 trillion of ETFs money are under management by ETFs. The number of ETFs grows based on the percentage asset growth also has surpassed tremendously relative to the growth of mutual funds. For ETFs, every time, in many cases, when the ETF is offered, the management also offers a menu of similar ETFs that differs in their leverage and short exposure. Okay, and the magnified exposure refers to the ultra or triple ETF. For instance, ETFs with magnified exposures use leverage to increase the bets. You can hear like ultra ETFs or triple ETFs. For ultra long ETFs, when the daily underlying goes up by 1%, the ETF goes up by 2%. For triple long ETFs, and when the underlying goes up by 1%, the ETF goes up by 3%. So they ensure that the magnified exposure at daily basis, but they do not guarantee that in the long run. ETFs with inverse exposure is called short ETFs. When daily underlying goes up by 1%, the short ETF will go down by 1%. So they have this inverse relationship. We also have magnified inverse exposure ETF, which is called ultra short or triple short ETFs. When the underlying goes up by 1%, the ultra short ETF will go down by 2%, and the triple short ETF will go down by 3%, and vice versa. The magnified ETFs allow investors to basically implicitly use leverage to magnify their gains and losses. And they can use less cash, but still have a target level of exposure. And sometimes if they don't have additional cash, but they want to invest or overweight a particular market segment, exposure magnified or exposure allows them to do that. Inverse exposure allows investors to short without using the account without using actual short sell, and they can seek profit from a market decline, and they can use short ETFs to underweight certain exposure to market segments. And this table, which is presented in ProShares website, which is a large ETF provider, and you can see that for major stock market indices, from S&P 500, NASDAQ 100, Dow Jones Industrial Average, mid-cap, small-cap, and Russell 2000, there are associated long ETF, ultra ETF, ultra pro or triple ETF, short ETF, ultra short, and triple short ETFs. Okay. Hedge funds refer to private investment pool that's typically open only to wealthy and institutional investors and largely exempted, is exempted from SEC regulations in terms of the strategy that can be used. Okay. Hedge fund doesn't have a lot of transparency, and investors do not usually know how the portfolio is constructed, what's their strategy, and typically only accredited investors who are defined to have at least $1 million investable liquid assets plus or $250,000 income for 2 or 3 consecutive years. Hedge fund may partake a strategy and shift between strategies, and they do not have a lot of liquidity. And they usually require investors to lock up their shares with the hedge funds for several years initially, and investors have to notice them about redemption beforehand. The compensation structure is much more complicated. In addition to charge a management fee, like expense ratio, which is typically higher than mutual funds, that's between 1 to 2% of the assets. They also charge an incentive fee, which is the 20% of the profits the hedge fund generates beyond some kind of benchmark. The benchmark can be the index or can be 0. Hedge fund strategies can involve directional bets or non-directional bets that's designed to explore the relative mispricing by hedging our risk. You will see hedge funds that conduct market neutral strategy called equity market neutral long-short hedges. They can be event-driven, try to profit from corporate events such as merger acquisitions, bankruptcy, restructuring. Some of the hedge funds are dedicated short buyers. They only go short to generate profits that uncorrelated with the markets or negatively correlated with the markets. Convertible arbitrage focus on convertible bonds versus stocks. Emerging market and fixed income arbitrage, global micro, long-short equity hedge, multi-strategy, so on and so forth. Retail investors may be able to gain exposure to hedge funds by investing fund of funds, which is traded on stock exchanges as closed-end fund, but with underlying assets investing in hedge fund strategies. In general, there's not much evidence showing hedge funds on average outperform the market. So the beta refers to the hedge fund exposure to the market portfolio, with S&P 500 has embedded beta of 1. So anything below 1 is considered to be less risky than the market. As you can see that they indeed are less risky across different strategies, and the short bias strategy have a negative correlation with the market. However, the alphas are not very large relative to the market, and the Sharpe ratio do not always beat the market Sharpe ratio, and we will explain alpha, beta, and Sharpe ratio in future lectures. Okay, so performance in recent years is not impressive, which explains the declining of hedge fund asset under management in recent years after the long bull market in passive strategies. Okay, so that's all we have for today. Thank you very much.